Hello and welcome to this video about Bollinger Band trading strategy. Bollinger Bands are a popular technical analysis tools that is used to analyze the price movements in the financial market. In this video, we will discuss what Bollinger Bands are and how to use them and how to implement them in your trading strategy. Come on, let's get started. So, what are Bollinger Bands? Bollinger Bands are a technical analysis tool, which means a technical tool that consists of a set of lines plotted 2 standard deviations away from a simple moving average of the price. The upper band is 2 standard deviation above the SMA and the lower band is the 2 standard deviations below the SMA. So it basically looks like some channel moving in a parallel way without coinciding each other. How to use this Bollinger Bands? See, basically Bollinger Bands are used to analyze the volatility of the price. So you know about the volatility. It is like the ups and downs of the market will increase in sometimes due to huge buying and selling in some occasions, like could be some market events or maybe some other particular news related things, anything like that. So in that volatility can be measured with these Bollinger Bands. When the price is trading within the band, it is considered to be a normal range. When the price moves outside the band, it is considered to be an overbought or oversold range. So that is how we read this Bollinger Bands. And when the price is in overbought or oversold range, traders may look for a potential reversal in the prices. So this could be an opportunity to enter or exit any ongoing trade. Implementing the Bollinger Bands in your trading strategy. So how to implement this strategy in your trading? So there are a few different ways to use these Bollinger Bands in your trading strategy. One common approach is to look for a squeeze. A squeeze in the Bollinger Bands occurs when the bands converge, indicating that the price is trading in a tight range. Traders may look for a breakout of this range as a potential trading opportunity. So traders, with this example will understand what is the squeeze breakout strategy. So see, this is a normal Nifty 15 minutes time frame, which is a recent price action. So now this, can you see, this is a squeeze. So this portion is called as squeeze. Why? Because you can see prior to that the Bollinger Bands are very wide and then it suddenly become very narrow. It suddenly become very narrow and then breaks out. So with this breakout, we can clearly see a green bullish candle here. So this green bullish candle here clearly signifies a bullish entry signal. So with this bullish entry signal, if we enter the trade here, so we are going to hit and ride this trend until and unless the trend continues to the upside, until and unless the Bollinger Band says again and closes back again, almost till this range, out of this range as a potential trading opportunity. Another approach is to use this Bollinger Bands as a confirmation tool. For example, if a trader identifies a trend using the other technical analysis tools, they may use Bollinger Bands to confirm the trend. If the price is consistently trading above the upper band, this may confirm an uptrend. If the price is consistently trading below the lower band, this may confirm the downtrend. So in conclusion, the Bollinger Bands are a useful technical analysis tool, which means a technical indicator to identify or analyze the price movements in the financial markets and take a decisions on your trades. They can be used in variety of trading strategies such as looking for squeeze or a confirmation tool for identifying trends, as with any other trading strategy. So it is important to use proper risk management and to thoroughly test the strategy and your position sizing before implementing in the live trading environment. So let's consider risk management and position sizing. With this, signing off, Dhanush. Take care. Happy trading.